history of the company since it went IPO in 2008. It is very clear that the company was able to, alhamdulillah, outperform the competition and the market, both from a top line and from a bottom line perspective, while delivering value to the shareholders. And despite the challenges that we've seen in the profitability in 2025, we're able to grow and reach a total of 16.6 billion in GWP in the first 9 months of 2025. Now, reflecting a bit closer to the financial performance, it's good to also have a refresh on our 3B strategy in the next slide, which is aimed to transform Bupa Arabia from an insurance company to a healthcare company by 2030. And the focus of that strategy comes from the 3 pillars, which are boosting the core, bending the curve, and beyond PMI. Now, looking at the financial performance of the 9 months, for the first half of 2025, and definitely in Q2, we've seen inflation increase dramatically across the board in reflection of the claims being shifted towards high-end providers. And definitely as a management, we've added the right interventions that both enabled us to actually start pricing for such changes in the dynamics in the market, as well as try to bend the curve of inflation through different initiatives internally. However, with insurance contracts, you always have a lag between the time you're able to manage your price increases in the sector, while also managing the competition and the pricing environment. Now, luckily, Q3 has been a step in the right direction. However, the 9-month performance still continue to be challenged from an inflation perspective. Looking at insurance revenue, we're able to grow insurance revenue at 5%. However, if we look at GWP, we're actually been able to grow it at 10%, and we're able to grow it by 1.6 billion if we look at the first 9 months of 2025, comparing it to 2024. That 10% growth continued in Q3, which signals that the competition and the market is adjusting its pricing environment, and hopefully it supported us in slightly elevating some of the pressures that we've seen in inflation in the first 9 months. That being said, the insurance service results continue to be lower than last year by 14%, mitigated slightly by the increase in investment income by 8%, which we will have a deep dive on in upcoming slides. Now, in the next slide, we reflect on the journey between the 9-month earnings before tax of 1.3 billion. And you can see that the drop in the profitability is primarily driven by the change in insurance results, which are a factor of the above expected inflation that we're witnessing in 2025. That is slightly mitigated by the increase in investment income and the lower expenses that we've seen from an operational perspective. Now, in the upcoming slides, I'll hand it over to Ahmed Bajnaid to give us a perspective on investment income.
Thank you, Abdulrahman, and welcome everyone. Thanks for joining. As mentioned, yes, the investment income has witnessed a very resilient results and growth compared to the same period of last year at around 560 million, or 8.4% growth, thanks to the duration extension strategy that we've followed over the past couple of years. As you can see in the middle chart, the portfolio composition has dramatically shifted away from deposits toward the Sukuk book, which helped in sustaining the investment income results to grow despite all of the pressures that we're seeing from interest rate reductions, which is expected to continue at least in the short term. We're expecting the investment results to continue to remain strong for the remainder of the year, given what we've done in the past. We think that even with rates reduction that are expected in the short medium term, the portfolio can still benefit from potential capital gains. That's all for now, but happy to answer any questions toward the end. Thank you.
Thank you, Ahmed. Yمكن as Hatem has mentioned, and as a response to the different requests we've had from investors and analysts, the market share and the different metrics that we typically look at from a sector perspective will be now reported 1 quarter in arrears. So the next few slides have already been presented in the previous investor call. So we will go ahead and skip that and go straight to the market information with Ali Shanemer.
Thanks, Abdurrahman. I mean, again, we are showing the same results of Q2. So for those who need the insured lives as reported by CHI, I have posted that in the chat. So you can go straight and see it. We will update it in the deck later on, and then upload it to our IR webpage. No major news on the enforcement yet. So I mean, there are lots of discussions taking place. However, no clear action or clear initiatives to increase the enforcement. At least the discussion that we are engaged in with the regulators on that front. Next week there is a big insurance conference in Riyadh, organized by Insurance Authority, which would be a good venue for us to discuss lots of market dynamics and points with them to see if there is any direction for 2026.
Thank you, Ali. I think we'll now go to Nasser Al-Jadai to give us some perspective on the inflation in the market.
Assalamu alaikum, thank you, Abdurrahman, and welcome everyone. A quick update about our inflation outlook. Since our last update, our view for 2025, inflation is still at 10.6%, and almost 3% out of the 10% is contributed by Article 11 claims. The main driver for the overall level, the 10.6%, is a change in the utilization pattern as well as Article 11. We're seeing more members seeking care and, importantly, shift toward high-cost provider. And this is a structural change in the claimant behavior and not a one-off event. So also it's worth mentioning that Article 11 providers have recently submitted billing for the first half of the year from January to June. And these claims got processed through our claim management team and are fully reserved for, and we're not expecting any impact of these claims. We have also added 2026 outlook, and looking ahead, basically we're expecting almost similar levels and a continuous pressure from Article 11 claims. We're expecting 2% out of the 10% from Article 11 claims, since basically the recent development in their submission during 2025 and the acceleration in the readiness in terms of submission and the quality of the submission. So this is all in terms of inflation. We have also added our seasonality and how basically our seasonality correlate with the listed provider revenue. As we can see, it's almost matching, and we're basically mimicking their revenue. That's all from inflation point of view and seasonality. I'll hand over now for Mohammed Al-Misawi for Bupa Care Connect update.
Thank you, Nasser. Hello, everyone. When we launched Bupa Care Connect, our vision was simple. It's to redesign healthcare delivery around the member, not the system itself. And 2 years later, we're no longer proving the concept. We're pushing hard to scale it. Our result this quarter show disciplined volume growth, tangible cost control, and a sustainable model that combines digital, clinical, and home care under the one integrated system. Today, I'll give you a glimpse and I'll take you through on what that transformation looks like in numbers. and why Care Connect is fast becoming one of the strongest integrated healthcare platforms. The slide you see in front of you is a population stratification. If we can go back to the, yeah, thank you. So the slide summarizes our operating logic. Just as a refresher, we talked about it previously. We stratify every member by risk level and match them with the right engagement mode, from proactive chronic care management to digital wellness. This is how we're trying and pushing to bend the medical cost curve. The sickest 5% of members drive roughly 50% of the total cost. So by embedding care navigators, medical care navigators, on-site physicians, and digital monitoring into those cases, we're trying to reduce avoidable admission, achieve measurable medical spend reduction for employers and the employees. Meanwhile, healthier population, we are engaged through our digital clinic and some of the wellness program, ensuring prevention and the continuity at scale. Next slide. In Q3 2025 and for the past 9 months, our reach and engagement accelerated. So we served 175 lives. We conducted roughly around 275 teleconsultation, and we delivered around 66,000 medication. I mean, 66,000 times we delivered medication to our members. And we processed roughly around 98,000 home lab requests. Each of these touch points represent a sort of a data feedback loop, informing our predictive model and improving outcomes. Our network now includes around 15 to 16 in-house corporate clinics, 52 doctors, and roughly around 46 active population health members, mainly for the top condition. Obviously, we're serving other conditions, but the most costly conditions, we have active, fully engaged and enrolled 46,000 members. Behind these numbers, obviously, there is a lot of operational discipline, cost optimization, digital automation, and relentless focus on member experience to ensure our members not only experience improvement in health outcome, but also excellent customer experience. So they stay in the program. Next. Q3 also marked a major milestone, the launch of instant consultation inside the Bupa app. So for the first time, a member can connect to a qualified physician in seconds without pre-approval or scheduling frictions. So there is no call back, there is no scheduling or booking appointment. It can happen instantly. It's real-time healthcare embedded with the Bupa insurance. And this capability fundamentally changes how we serve our members, converting healthcare from episodic to a continuous care. It can also happen in different touch points. For example, our member can go to any pharmacy chain, and in order to get a medication, if he needs a prescription, he can instantly have that consultation through our app and have that prescription and get his medication, which is extreme convenience. He doesn't need to go to the hospital and go to see primary care doctor to access that. Next. Our integrated clinic strategy also bridges digital and physical care. The first flagship site in Riyadh will go online very soon. We have roughly around, I mean, it's a sizable multidisciplinary clinic, 4,800 square meters with 28 examination rooms, or what we call clinics, 31 doctors, more than 15 specialties, 53 nurses. That's for the first phase. Everything is designed around the member journey. Each clinic connects directly with our digital ecosystem. It's the same HIS we use for our digital health and our physical provision, and they're all connected. So prescription, labs, and follow-ups are synchronized in real time. This hybrid model is how we think genuinely that value-based care will be delivered at scale. Next. Our home healthcare network is now fully operational across the Eastern region. We've got our license in Eastern region, and we deliver directly. The other regions, we're working on obtaining our license, and we'll get it very, very soon. We provide physician visits, nursing care, and physiotherapy directly at home, fully integrated with our digital record for the enrolled population, and also remote monitoring. It's the final sort of a piece of continuity of care from virtual triage to bedside recovery. This capability is not only driving patient satisfaction, but also keeps the medical spend sustainable by reducing a lot of dependencies on heavier healthcare episodes. So what you see today is not incremental healthcare improvements. It's a system redesign around the member. It's proven that when there is an integrated care, especially if it's enhanced or augmented by digital work as one, health outcomes improve, cost curves are flatten, and our next phase, and it's the commitment of everybody, is scale, expanding our clinic footprint, automating through AI, which is not there yet, and deepening the partnership with employers and regulators. So with that, thank you. And if you have any questions, I'm happy to answer.
Let's go to the next page on the highlights. These are just a brief of whatever announcements were made during the past period. As you have seen, we have announced with the Dawal that Bupa Arabia received the no objection from Insurance Authority on its proposal to restructure the company to transform it into a holding company. And also in August, we also received the approval to sell domestic helper product as one of the new products in anticipation of more deepening of the enforcement, because currently it is still on a very small segment of the domestic helper, those with 4+, but in anticipation for 2026, if they start going to the lower segments, which means higher population, at least we have enough learnings on that product to continue improving it. The rest of the announcements have been discussed in previous calls. And these are just quick highlights of whatever announcements from the various regulators and stakeholders that could have some impact on the sector as per the MOU signed between Insurance Authority and Ministry of Culture to activate cultural insurance sector. Probably not relevant to health, but this is important for you as you cover insurance in general. This was announced during the quarter. The rest of the highlights have been mentioned in previous calls. And this is my usual brag sheet where we show off the awards and recognition that we have received. I think the latest one was from Kantar, where Bupa Arabia was ranked 6th most valuable Saudi brand in their 2025 release. The rest, I think, have been shared previously. And probably this is a good time for us to start our Q&A, Hatem.
Sure. So we are ready to go for the Q&A, Lena.
All right, thank you very much for the presentation. We will move to the Q&A. If you have a question, you can click on the raise hand button and I will unmute your microphone, or you can also write your question in the chat. We'll take the first question from Abdallah bin Masad. Your line is open. Please go ahead.
Assalamu alaikum. Congrats on your set of results. I have 3 questions, if you allow me. I will start with the repricing activities. If we look at third quarter performance, it's promising, Bupa moving in the right trajectory. However, there was a deviation between SMEs and large corporate. If you can shed more light regarding the performance of both segments and why a deviation appeared during the third quarter. My second question is regarding inflation. 2026 inflation is still on the high on the double-digit front. I recall there was a change in regulation with related to Article 11, where insurers with the government hospital need to sign contractual agreements, and that should ease part of the inflation. But still, Article 11 is contributing to the overall inflation. How do you see that? And a question regarding the base inflation, it will increase slightly during 2026. If you can shed light on that front. My last question is to Ahmed. Mashallah, investment income, you were ahead of the curve when it comes to increasing the duration. How do you see the upcoming cycle, and how do you plan to position Bupa overall portfolio? In which asset classes, more specifically, you plan to inject more money in the upcoming period?
Thank you, Abdullah, and excellent sets of questions. So let me start by the first 2, and then I'll hand it to Ahmed. First of all, the results you highlighted regarding the different segments for corporate and SME, you're talking about the GWP, or you're talking about the loss ratio?
Insurance service results, or technically loss ratio.
Yeah, so sure. So actually, the deviation you see and the differences are mainly related to the construction of the policies and the concentration between high-end and low-end providers, and that's what's driving it, not by segment. Because when we compared like for like between corporate and SME, the behavior and inflation is the same. However, the construction of the portfolio between high end and low end is what's driving the deviation you're seeing. But across the board, we do see higher than usual inflation. And this is actually related to your second question, and it's good that you're actually keeping track, because you're absolutely right. We closed last year with inflation heading into the single-digit territory. But as we highlighted beginning of this year, it reversed back to double-digit. And as Nasser presented in the inflation slide, we do see the trajectory continuing at the same level. Regarding Article 11 specifically, so back to your question, we do believe there will be a contribution of MOH providers. Actually, as you might have heard, there has been a submission of claims for the first 6 months related to MOH providers, which were higher than usual. But it's already provisioned for, it was already projected. So there are no implication for this year, but that changed the trajectory into 26. And we do believe the readiness of the MH providers is improving. And we are expecting higher inflation also coming into 26, which is why we kept our projection at a double digit for 26 as well. So just to summarize, there are two drivers that are keeping inflation at that level. One is the structural shift into high unit cost providers, which we've seen. And when you look at the publicly listed provider, you do see growth level at the 20%, which is driven by the concentration of those providers. Second is Article 11, which is based on the first 6 months submission for this year, is expected to continue growing, given the readiness of those providers. I hope I answered your question, Abdullah.
Clear, but specifically in the third quarter numbers, the improvement in large corporate segment was more noticeable than SMEs. I understand that similar inflation trajectory affected both segments, but the loss ratio was way higher on SMEs relative to large corporates.
Yeah, but again, the interventions that took place, actually, if you go back to the previous quarters, you might have noticed a higher deterioration in corporate, which the effect took place earlier, which is reflecting now in the results. So that's hopefully will catch up on the total portfolio level in the coming quarters.
So is it fair to say the repricing activities with large corporates faster than SMEs?
No, it started earlier.
Okay, clear. الله يعطيك العافية.
So I'll go to Ahmed for the third question.
Thank you for the comment, Abdullah. For us to actually understand what's the best positioning for the portfolio, to see how the cycle is likely going to look like, which is very, very tricky. إحنا strategy, the direction will not change to be focused on income generating assets. And the environment in the past 2 years or so played in our favor where rates were going up. So now going into or heading into a lower interest rate environment. And the tricky part is, while rates are coming down, yields are actually not behaving in the same fashion, at least not in a lockstep. So the focus, it really depends on how you're seeing the economic growth is going to unfold in the short, medium term, because it actually addresses to what extent you can take more credit risk into the portfolio, which is a very, very tricky environment right now because of everything that we're seeing, where the whole point of the pressure of bringing rates down while inflation is still sticky is to manage the pressures on economic growth. So I would say going into 2026, no major changes in terms of the direction of the portfolio in terms of deployment, while we still see an opportunity in the private credit space to further mitigate the interest rate reduction until the environment stabilize a little bit. We see an allocation to growth assets like equities, or even on the private side, private equities could be actually interesting. You can still expect very good performance from these two asset classes in the next couple of months. But for us personally, the valuations that we're seeing don't justify a big entry or a strategic positioning at this stage. So we don't foresee a major shift in the composition of the portfolio, at least until the second half of 2026. And we see a clear direction of the rates and how the market conditions could actually evolve. More of private credit, a bit more on the sukuk space, where the rates and the yields are still attractive. Yes, lower than what it was, but definitely not as low as we expected a year and a half ago, when the whole notion of rates reduction would have taken place. I think only if you're focused on very short-term papers or deposits, the impact is going to be big. So alhamdulillah, for us, we are in a luxury position not to take excessive risk at this stage. We'll just wait and assess.
كريستال كلير. الله يعطيكم العافية وش all the best.
Thank you.
Thank you.
Thank you. We'll take the next question from Salome. Please go ahead.
Hello. Thank you for taking my question. I have actually three questions. Question number one on the composition of the insurance-related costs. If you could explain the general idea behind onerous contracts that came significantly higher compared to last year. How shall we understand the rise in this type of cost? The second question on the high-level strategy of Bupa Connect. If you could quantify your target KPI from tapping the healthcare market. For example, your competitors are targeting, let's say, 20% cuts in hospitalization expenses. So what is your business case? And the third question on the utilization of the Bupa international know-how. If there is an actual case, if you could summarize, how do you access and utilize the experience from Bupa International, if that is a case? Thank you.
Sure. Thank you for the questions. Maybe I'll hand over to Nasser for the first question on onerous contract.
Thank you, Hatem. Just the high-level explanation of the onerous contracts in general. So the onerous contract assesses the whether the contract remaining coverage is profitable or not. And the remaining coverage is a function of two things: a function of the seasonality of the remaining coverage of the contract itself and the expected inflation on that remaining coverage. So why we're basically seeing a higher loss component during this quarter versus last year similar period, because of the inflation itself is higher than our expectation. Hence, we had to book loss component. So this is why our existing loss component level is higher than previous year level. Also, the portfolio size, as explained by Abdurrahman, is by design higher. So that definitely will lead to higher loss component in general. So these are the two reasons why basically our loss component level is higher than the last year.
Thank you, Nasser. And Med, if you can comment on the second point on the strategy of Care Connect.
Okay, Hakan. We don't have a similar target to the competition, though the benchmark studies are, all of them, they target like 15 to 20%. What we know from our direction and our ambition is ultimately in few years, we want whatever ecosystem we will build outside the hospitals to contribute to roughly 25% to 30% to the bottom line of the Bupa group. That's how we're looking at it. We're not looking at it from the percentage of a reduction in terms of admission to the hospitals. We're rather looking at it from a bottom line perspective and how can we design an ecosystem that allow us to contribute to 25% to 30% to the bottom line in the next few years. This is the direction. However, the first 2-3 years, we're focused on the building and the scaling, and we're not worried much about the target of reducing admission or keeping members away from the hospital, because we work hand in hand with the provider. We don't see them as competitors, we see them as partners. Ultimately, we have to refer our members to be treated in the hospital, even if the members don't go to the hospitals, but to manage the health outcome and to manage the health spend on the long term. we have to work hand in hand with the hospital. So we don't see it in terms of preventing members to go into hospitals. Rather, we see it how we can build an ecosystem that works hand in hand with the medical health provider. And basically, ultimately, that ecosystem contributes to 25% to 25 to 30% in few years to the bottom line of Bupa Arabia.
And on your third question on the benefits we're getting from the learning from the other markets globally for Bupa, this is definitely the case. As you might know, Bupa globally is a healthcare company with different lines in the healthcare and aspiring to build health ecosystem, as Med mentioned, and we do have best-in-class examples from around the globe in the UK, Spain, or Australia, and this is definitely some of the aspirations we are trying to get to. Plus the technological advancement which we are also learning from and applying in our healthcare ecosystem. So there is definitely learnings that are being shared around the group on the best practices on how to build an integrated healthcare ecosystem.
Thank you very much. This is very, very helpful. Just one small follow-up on the CapEx related to the Bupa Care Connect. How shall we see the CapEx? Is it part of the insurance expenses or is it part of admin expenses? Just to have an idea where to look for the CapEx quantification.
Sure. So you won't be seeing the CapEx expenses clearly of Care Connect. Care Connect in the embedded results is a provider of service to Bupa Arabia. So this is part of the claims we are receiving. However, as we mentioned in earlier earning calls, that we are going with an asset-light model where we are trying to engage the customers digitally, and then only referring for cases that are needing interventions physically in the clinics, which, as Med mentioned, first one would be opening soon. So based on the current reporting, it won't be possible for you to isolate that CapEx level, but it is embedded as part of the claim expenses.
Thank you very much.
Thank you.
Thank you. We'll take the next question from Abdallah Al-Buraidi. Please go ahead.
Thank you very much for the presentation and congrats for the good result. This is Abdul Brady from Emirates MBD. When we dissect the insurance service expenses, we notice that the net insurance margin bleeding has stopped this quarter, and it is way better when we compare year over year compared to the last quarter. But when we dissect it, we notice that the incurred claims and other direct expenses is still spiked, and most of the improvements coming from changes related to past services and lower onerous provision. What's your take on this? Is it started to improve these repricing activities? Are they showing up and from this quarter, or should we expect them to improve going forward?
Sure. So actually, Abdurrahman mentioned it slightly in the presentation, but let me just shed some light. When you compare the pricing level on average for the market, first half and second half of the year, well, first half and the third quarter of the year, you do see a pickup, which is the main reason behind the improvement you saw. So first half of the year was around the single digit. Quarter three is in the range of low double digit, but it is heading in the right direction. If you look at the results of the market overall, you would see that overall the market is significantly down when it comes to insurance results, which is an indication of the pressure the different players are seeing, which is again gives indication that there will be a correction going forward. Actually, we mentioned in Q2 that the correction activity started already, but because of the lag, it takes time for the different players to see the improvement. But I mean, as we highlighted earlier, that the activity started, the improvements, as you rightly mentioned, are showing. Hopefully that would continue, and hopefully we see a sector that is recovering in Q4 and in 2026.
Yeah, two more question. While we noticed that on your inflation expectation are still intact and they are still very high, and we notice this flu season is sharper than before, and the consumer behavior and the length of repricing that takes time. Should we be worried about the fourth quarter?
Look, the fourth quarter generally, again, for the entire sector is a high claim season, and then you notice that most of the insurance players have their highest loss ratio and highest level of claim in Q4. So this is the flu season you're talking about is a seasonality element that is embedded in the projections of insurance companies. So
Sorry to interrupt, but I'm comparing this fourth quarter to last fourth quarter.
Yeah,
I'm aware of the seasonality.
This is what I'm heading into. So again, I can't generalize for the sector, but you would, I mean, depending on the recovery intervention, whether it would materialize or not. If it does, you would expect to see a similar quarter. If the catch-up is slower, then you would see a hit. And again, I'm talking about the market overall. And I will not be giving prospective expectation on Bupa Arabia specifically.
Okay. My last question regarding X-Pro. We noticed in that you've mentioned as well in the last quarter that X-Pro benefit is ridiculous, and they are way, way higher than the CHI. And as we become to the end of the year, the master policy is going to expire, and that there are only 3 players that are approved for X-Pro. Do we attribute most of this high loss ratio to what's happening in X-Pro benefits, given that even when we see the corporate, and I assume all of X-Pro are in the corporate segment, is more hurt than the SME?
Yeah, the answer.
And how should we look at it going forward, given that most of the market is being hurt from it?
Sure. So the short answer to your question is yes. So again, you do see the hit and the higher inflation on higher end policies, and definitely X-Pro is one of those segments which has rich policies. So the level of inflation is higher than the average you see for the market. So they are part of that trend. It is still high. The process is to qualify the players once a year. So every year there is a renewal of the contract, which didn't kick off yet in terms of renewal. I cannot comment on adjustment to the policies to mitigate that, but I know for a fact that there is a discussion on how do we control. When I say how do we control, this is a discussion between insurance companies and X-Pro on how do we mitigate that high level of inflation going forward. But so far there are no changes. And again, back to your starting point, it is a portfolio that is driving a high level of inflation on all 3 players.
Okay, thank you very much. Allah
Yafik.
Thank you. We'll take our next question. The next question from Raja Ader. Please go ahead.
Good afternoon, gentlemen. Thank you very much for the presentation. I have 3 questions, please. My first question is a follow-up on the surge in SME expense escalation we saw in the third quarter. You had mentioned the shift into higher-end providers as a reason for higher expenses, but I just wanted to clarify, is this shift also impacting SMEs, and how so, as I believe the bulk of their network is either B or C? And my second question is on investment allocation. I understand from what you said, Ahmed, we should not expect an increase in fixed income allocation going into 2026. Could you give us an indication of your average duration today and whether you have any targets to increase equities further going into next year? And my last question is on Article 11. Are MOH hospitals connected to NEFIS? I've heard that they've been connected over the second quarter of this year. And would there be any rationalization of claims as a result of that? Thank you.
Thank you, Rajan. Great to hear your voice. I'll take the first one and then I'll hand it over to Ahmed and Ali. On your point on SME, actually the construction and of the portfolio for Bupa is different from the market. We still have a higher concentration of high-end products even in our SME book. So our construction of the book is different from the overall market. And yes, that level of that surge of claim is we're seeing across the book. It differs by whether the policy is high end or low end, but it's the same if you look at the different segments in terms of SME, medium, or small.
Clear. Thank you.
Thank you. Matthew?
On the investment income, so the duration is a little over 3.5 years. What was the other one?
About MOH hospitals being connected to NEFIS platform, was that effective this year?
I'll take that, Raja. What we as sector did is we signed a unified contract with all MOH hospitals in July. And the change in that contract is effective November 1st. We will enforce pre-authorization on the services that require pre-authorization. In the past, before signing the contract, MOH hospitals were not required to request pre-authorization. So this is the major change that took place. In terms of price list, it is still the same. So it is dictated by CHI and still applicable. In terms of open network, still applicable. So the change is enforcement of pre-authorization. This will have definitely an impact for sure, but we are yet to assess that because it just started a few days ago.
But they are not transitioning their claims through NEFIS platform, and they do not abide by the standardized coding.
They are submitting on NEFIS. They are
okay, very clear. Thank you very much.
We will take the next question from Waruna Kumarage. Please go ahead.
Hello. Hi. Good afternoon, gentlemen. Am I audible? Hello.
You are, Marwan. You are.
Yes, Waruna.
Yes. Hi.
Please go ahead.
Thank you very much. Just to first to follow up on that question on the MOH claims, two parts. The first one is with MOH claims coming through NEFIS. So that means that the NEFIS, the charge, who will be paying that, and the hospital will be bearing the entire thing, or is insurance companies sharing that cost? I just want to understand how the NEFIS charge works. I mean, the usual amount that is usually charged on the percentage. That's my first question. And secondly, like Ali mentioned that, I mean, there could be positive impact coming from pre-authorization. So your expectation of, Article 11 inflation impact going forward, can it be better than what you anticipate, that 2% or 2.6% that you expect next year? That's the second question. Thirdly, on again, sorry to go back to this SME's profitability, but just to drill down, but this SME, the margins decline in third quarter is actually not coming from onerous contracts. It's coming from incurred claims. Unlike in the case of corporate, where second quarter, I think it came from onerous contract, and like you mentioned, because of your actions, I think that part has gone off. But whereas in SME, it is coming from incurred claims. So I just want to understand why it happened in third quarter. Is it again? I mean, I think you mentioned that it happened because of high-end providers. Just want to clarify that. And lastly, on again, I want to clarify from Ali whether this we have this number of beneficiaries in the CHI website. Is that amount as of the quarter end, third quarter, or is it October end?
Okay, I will have to answer two questions. First, on the fees levies. What we know is insurers are still required to pay 1%. So when MOH providers submit to fees, insurance companies will pay on the accepted claims 1%. Now, whether Nafis is charging MOH hospital or not, that's something I'm not aware of. Ideally, they should, because it's a service they provide, and they should charge for it. But I'm not the right person to answer if MOH is paying it or not. On the question, yes, CHI, in the link it says Q3. So you need to download the file and then you do the analysis on it. It is updated and also detailed.
So Rona, I'll try to make sure I'm keeping track of your question. So please feel free to correct me. But I'll start with the inflation coming from Article 11, and I just want to clarify it because you are building up on a question that came earlier. Even if it I mean, MOH coming through Nafis, why would you expect it for the inflation to be lower or better?
No, actually, it came from the fact that you mentioned about pre-authorization, right? With pre-authorization required, maybe your
Okay,
claim
got your point.
pressure will be less, right?
Yeah, I got your point.
Yeah.
Yes, true, but the inflation from MOH coming from two elements. One, and it is related to the readiness of those providers. So one, you are already receiving bills for services that used to happen in the past, but was not billed to insurance companies because of readiness. Now, a lot of those providers have RCM companies working with them, and they're building up those capabilities. And second, you have a list of providers that did not used to submit in the past, and now they're starting to submit. You net that off with approval or pre-authorization. Net, we still believe there will be an increase based on the level of readiness we are seeing over the years. So still the expectation is for those claims to go up. I mean, judging only from the level of claims we received for the first 6 months of this year, it was significantly higher than the year before. When I say significantly, I'm talking almost double. The good thing is we're already reserved for, and that was built in our forecast before the submission came in.
Okay, that's clear. And regarding the SME question.
So Nasser, do you want to shed some light on the SME increase in loss ratio?
Yeah, sure. So basically, the SME, you mentioned the why the loss component for SME is different from the corporate, and you're saying the increase in SME coming from the incurred claims. So in general, we can't compare these with corporate because even the earning pattern, how we write SME business, is different from corporate. Corporate is skewed toward the first quarter of the year. And this has been already reflected in the results. So in general, the changes related to past service, even the loss component will be different from SME to corporate. And the increase in the incurred claims of SME in specific, again, this can be attributed to the increase in inflation and the shift toward high providers. So this is the main reason why SME incurred claims is higher.
Okay. Maybe the accounting, I think, probably is different because when I go to a segment breakdown, this the onerous contract part doesn't appear. It appears only in corporate, but doesn't appear in SME. So probably
Yeah.
it's embedded in incurred claims, maybe, right?
But just to highlight also something here, Varuna, on onerous are contract on the expectation going forward. Naturally, corporate are priced at higher targeted loss ratio, hence they have higher probability of crossing the line into being onerous.
Mm-hmm.
SME are targeted usually on lower loss ratio, so it's harder for those contracts to cross to that side. And then we didn't say, by the way, the losses are coming from onerous contract. This is not the case. We said the inflation trend driving the loss ratio up is what drove the lower profitability, but it doesn't mean you would see it in onerous contract. It doesn't mean you would see SME onerous contract. No, it's just higher loss ratio versus history.
Okay, makes sense. Thank you very much, gentlemen. Thank you.
Thank you. We'll take the next question from Trifonas Spiro. Please go ahead.
Hi. Thank you for taking my question. Just coming back to the change in behavior, you said it's structural. I just wanted to better understand. Maybe you can share your views on how what is driving this and why it has emerged, I guess, in the first half of this year. So any thoughts on what's actually driving your policyholders to go to more expensive providers? And then just secondly, just to clarify on your question on Article 11, and just to confirm my understanding, it appears that you had a backlog basically of claims coming through that you became aware of, and now you have reserved for them. And I just wanted to confirm if that was the case in Q2. So and that the exercise was done in Q2, and that's now done. Thank you.
Thank you. Let me just clarify the first question just to make sure I understood you correctly. Your first question is about what's driving the trend to high unit cost providers that is driving the inflation, right?
Yes. So what is making the people go to these more expensive providers?
Sure.
Yeah.
Sure. So obviously those high unit cost provider are providing superior services, and they are actually providing very good services, which with time is driving more members to go to them. But also, if you go back and check over the past 3 years, the increase in supply and expansions from those providers, you would see that they went up significantly, either through opening up new units, hospitals, clinics, or acquiring different units and clinics. Hence, the concentration that is driven to those providers. So I don't recall the number, but the number of beds added during this period from the high unit cost provider was much higher than the 10 years before. So that is what's driving the build up for those providers, in addition to the quality of the service they are providing. And clients are also preferring to keep those providers within their network, given the quality of the service. So that drove the catch up in increasing the utilization for those providers. So this is on the high unit cost providers. For Article 11, just to give you a bit of the background there, beginning of the year, there was a regulation for Article 11 providers not to submit claims without signing contracts with insurance companies. That took time. And by the end of half one, they were given a window to resubmit old claims, because originally they were not able to submit claims without signing contracts with insurance companies. That took time. After that was completed, they were given a window to submit claims from the first 6 months, which we've received, and we are in the process of closing those claims and settling it, which is what drove the pickup and the increase in Article 11 claims.
And that was in Q2, right? That impact came in Q2, or is that also in the numbers at Q3?
No, the claims received in Q3, not in Q2, but it is related to the first half of the year.
But you reserved for this in
Yes.
Q3. Okay.
Yes.
Okay. Thank you. Thank you.
Thank you. We have time for our last question. We'll take the next one from Michael Christelis. Please go ahead.
Firstly, on Care Connect, am I right in saying that over the long term, so maybe 5 or 10 years out, once you have completed your investment cycle, you're not looking to improve claims costs or underwriting margin through Care Connect, but more actually capturing a portion of that cost through your own service provider, essentially. So we shouldn't be expecting higher margins over time to result from Care Connect in the underwriting business, but actually just more of a separate business unit that's generating profits on the healthcare provision side. So that's my first question. And then the second question is just around claims inflation over the very long term. Is it we've seen typically in other markets that generally runs at CPI or RPI plus somewhere between 2 and 4%. Would you agree with that over the long term?
A very good question, Marcus. Allow me just to highlight the first one. Actually, the answer is no. So it is the combination of both. You would expect the benefit of Care Connect to appear in terms of lower claims in insurance, but also it is expected to be financially feasible venture. So it's not expected just to drive cost saving. It needs to be a business, a standalone business that is financially sustainable. So it's a combination of both.
And just to clarify, would that benefit then be invested into price to gain share, or is that expected to be long-term accretion to margin?
Absolutely. So you are asking the right question. So depending on the level of value that will be generated, the expectation is part of that value will be passed back to customers in terms of discounts, and part of that benefit could be captured in the insurance business in the sense of lower claims. So, and that decision is dependent on the quality of the service you are providing that would allow you to either claim that premium because of the better service, or passing it to your customer in tough times where discounts are more valuable than the quality of service. So
it's very clear. Thank you.
By the way, that's the model across Bupa globally, where the integrated care model allows you to benefit either from the venture itself or from the value you're driving to your customer.
It's very clear. Thank you.
Yeah. On your second point, I'll try not to give you a very long answer, but I'll tell. I honestly speaking, with the current setup we have in the market, where you have a market that is structured. I'm talking about the healthcare market that is driven by fee for service, where the higher the utilization, the higher the benefit to the providers, you would expect such high level of inflation. Add to that, majority of the population going to private providers are insured by their companies. So behavior of overutilization does not impact members directly, but it impacts the clients buying the policy. And add to that the possibility and the ability for the members to go to any hospitals or consultants with no gatekeeping through primary care. I do believe that those two factors are contributing to that high level of inflation compared to other markets. And without interventions tackling those, yes, I would say you'd expect to see that level of inflation.
Very clear. Thank you very much.
Thank you.
All right, we will have to end the call here. I would like to thank the management team for their time in today's call, and I'll hand it over now to Hatim Jamar for any closing remarks. Thank you.
Thank you, Elena, and thank you all for the great questions. hopefully we'll keep that momentum of having the call early on based on your feedback and sharing our results with you the soonest. And hopefully we'll have you all again toward end of the year. Thank you.